Welcome back to the Dividend Diplomats YouTube channel, everyone. Lanny, Bert, who are we? We are the freaking Dividend Diplomats. We are recording our journey to financial freedom by investing in undervalued dividend stocks and sharing our thoughts along the way with all of you, our loyal subscriber base.
Oh, it's true. It's damn true, guys. And Bert, we need the people to do just two things. Subscribe, give the video a thumbs up as we reach the millions and millions of dividend investors out there. For what is today's video about, my brother?
All right. So last week we did what we call, it's not a TED talk. It's an investing talk. We shared our thoughts on the 2023 market. We went through a few topics last week. We talked like what we were expecting in 2023, what could possibly happen, what are our favorite stocks going into the year, and what's your expected dividend growth on your portfolio. That was part one of our series. Part two of the Diplomat Talk on investing series. That's a good name for the series, the Diplomat Talks. Anyway, all right. Part two, we're going to cover a few other topics, and then maybe we'll see if there's enough for part three, part four, and so on, if you leave us feedback below. Lanny, what are some of the topics we're covering in part two of our Investing in 2023 series?
Guys, today we hope to cover, and if we don't, we'll go into another part tray, the trilogy. We'll talk about cash. Right now, banks and credit unions and investment brokerage firms are trying to fight for every dollar. They want you to have your cash account with them. We're talking Ally, SoFi, Marcus, Fidelity, M1 Finance, Capital One, Discover, VO
Cool.
Savings, you name it. They all are fighting for your dollars. So you're able to earn a 3.3 to even over 4% right now on just cash sitting there. So we're going to talk about cash and what you should do. Should you invest or should you just take the risk-free rate, and why? We'll talk about ETFs. Do you plan on buying more ETFs? Between Bert, do I plan on buying more ETFs, changing up my investing strategy in 2023? More on that. And then we'll talk about any new positions. Does Bert plan to open up that Microsoft stock as it was dropping? Does he want to continue to add, maybe to his Dividend King positions that he was starting last year, like Stanley Black and Dumper or Black and Decker?
Hey,
and even
they're coming back. Don't knock them. Don't knock them.
They are coming back, and then also to see, hey, there's been a lot of spinoffs in the industry. We're talking Glasgow, spun off Halion, ticker symbol is HLN. AT&T's big deal, spinning off Warner Media Discovery. I'm sure everybody or a lot of people are still holding on to that stock. So there's a lot of positions. Bert still has Occidental Petroleum, OXY. Warren Buffett obviously dumping billions into that investment, obviously generating a large return. So there's a lot of companies. And if we get to it, we'll talk about that as well. And there's so many more topics. But again, we'll talk about cash and what we are doing and what our take is on holding or investing ETFs and opening or adding to other positions.
So cash, everyone. 3, 2, 1. So cash. Let's talk cash. And Lanny teed it up perfectly. That's the big thing. We all fight for every dollar. We all fight to save as much as we can. And sometimes, what we always suggest for cash, at least from our side, is we love investing every dollar possible, but there's also your emergency fund. And you want your emergency fund to be accessible. You want to be able to tap it when you need to. And from where I'm standing, I'm sure Lanny's in the same boat. We like to have our emergency funds in cash in a place that's FDIC, NCUA insured, because, if you need to access it quickly, you can. Some people may differ. Some people may be more aggressive and say, I'm investing it all. Just, hey, we like to keep it on the sidelines. And I think Lanny covered a bunch of tools on how to make the most of that dollar. So just because you're keeping it in cash doesn't mean your cash can't work for you. It doesn't mean you can't earn more from it. So what am I doing from this? I'm putting my cash into a high yield savings account right now. I use SoFi. SoFi currently gets me 3.75% there. And what we're going to do is for these accounts, we'll each put which ones we use, some of the links down there below too, if you're interested in opening them up and looking for them further.
And actually, Bert, I know on the blog, I know you just published a nice page on our website regarding how to maximize just idle cash.
Yeah, you're right. And I think we're going to cover there. That's the whole goal of it, is to earn more. We share the 4 different ways there. I employ number 1 for my emergency account, but I also have worked with some of the other strategies too. With my mom, I've helped with some of her cash. Another thing you can do with your cash is to build a CD ladder. You can then also open up a money market fund where you're earning some above market rate, and you can also build a treasury ladder if you want to. So those are some great options, because Lanny, what are you seeing with rates in the CD market now that may be appealing to people?
Of course. So guys, right now, obviously, probably with 2 years and less, you'll probably see rates anywhere from 3.75 to 4.5 on those interest rates on those shorter to moderate term CDs. Obviously, they're trying to protect their long-term cost of funds on that side. But so you can really start laddering out every month, a short-term CD. Mm-hmm. I think Ally even has a no penalty at like 3.85 on an 11-month. And then you could even do a 4.25 on the 12-month. So really, there's a lot of battles going on right now amongst the CD market.
Yeah, so there's a lot of mismatch that you can create. I know some of your brokerages, I know within Fidelity, for me and Vanguard for my mom, you can actually invest in CDs within the brokerage account. So you can buy brokered CDs to where Ally doesn't need to go to an investment company, because they have such great marketing and such ability to go to consumers. There are a lot of banks and a lot of credit unions out there that need to work with brokerages to offer their CDs to investors out there, and that's available for you. So that's another avenue if you want to start building that CD ladder. You can get them in your brokerage account. Money market fund, very similar. Cash is liquid. Brokerage, whichever fund you're going to hold in. I know Fidelity has their money market account. They invest it in very short duration things. They'll invest it in very short-term treasuries, municipal bonds. There are different ways that they can do it. Very safe, but it's still not this quite same risk-free level as a high-yield savings account, but it's pretty darn close. And with this, the rates on those have shot up too. You can get 3.75. You can get 4% on a money market fund in your brokerage. It's another great way to earn a little bit more on the cash that's sitting.
Exactly. So, Bert, with that, do you want to keep your money on the sidelines, or are you going to just, what are you doing? Are you going to keep investing when you can get a risk-free rate at 4% plus?
No, I mean, I'm going to keep my emergency fund on the sideline, of course, but for me personally, I still like to invest as much as I can. I mean, there is the risk-free rate, but look at the stocks I'm buying here. I'm buying Johnson & Johnson. I'm buying, I haven't been buying Procter & Gamble. If you look at our 5 foundation stocks, let's just use them for an example. Johnson & Johnson, Procter & Gamble, McDonald's, Consolidated Edison, and Pepsi. Those are companies that, sure, the yields might be slightly lower than the risk-free rate now, but over 15 to 20 years with the appreciation that goes in with the dividend yield in the compounding, you're going to beat what you'd earn from interest on the risk-free rate and stay ahead of inflation in the long run. And our goal is to build that long-term income. So while it's great that you're earning more on cash, you don't have to rush to invest it now. That's the beauty of it. I think you don't have to say, like, I'm earning nothing on this, I need to get into the market now. It affords you time to be a little bit more patient with your investments, but still, I want to get as much money into the market as I can. What about you, Lanny?
Yeah, I mean, essentially what Bert's saying is he's trying to buy undervalued dividend stocks because you might get the appreciation. But, for me, I'll parlay with what you're saying with the yield on cost. So, like, we'll take Medtronic as an example. Sure, they only yield like 3.3 to 3.4%. But if they continue to grow that dividend at 5 to 10% per year, that yield on cost on my initial investment is going to go up. That's not what happens when you're investing into a savings account, or not even, investing in a money market fund. That's not how it works. And the second the Fed's done with rates, you're done. And the second that happens, the appreciation of the market has already been pegged in. So you can't buy Medtronic when it yields at 3.4%. You might get them at 2.5%. So now you've missed on the appreciation, and now your yield on cost is far lower than what you're investing into now. So I'm still buying dividend stocks. Any idle cash, emergency cash, down payment for a house cash, keep that in a high yield. But everything else, buy assets on sale, because in the long term, you're going to crush it.
Yep. Yeah, I think that's we're both in alignment on that message there. They serve great purposes. It's awesome that you can earn more interest, but you still want to get the money into the market in the long run. So question number 2 here we're going to talk about. So any ETFs that you own that you want to add to? Lanny, I'll let you kick this one off here because I know you're big on the consistent weekly ETF investing.
Well, we got an article coming out tomorrow on the blog on Friday. You probably saw the tweets on the Dividend Diplomats about the new trifecta Vanguard strategy. You know, and it wasn't about shifting where my money's going. I'm trying to personally, and those that follow me on the other item, I'm trying to get down to the zero budget here. I'm trying to use every dollar. So if I have more money to invest daily, I'm going to probably put that more towards an ETF right now. Obviously still buying a plethora of dividend stocks. But my ETF strategy is now going to be full automation using the SoFi app. So I'll be buying, weekly still VYM, daily still VOO, the S&P 500. And now I'm adding to the repertoire, the trifecta. I'm buying VIG, Vanguard's Dividend Appreciation ETF, a little higher yield than the S&P 500 ETF. A little bit lower, though, than the VYM, albeit the dividend growth rate, though, is stronger than both based on the 5-year historical average.
Yeah, I mean, it's a great strategy to get the consistent investing in the ETFs. I know for me, when I moved a lot of money over from retirement accounts, I put them into ETFs. I don't have the same purchase strategy of buying into ETFs right now. I own a lot of VYM2, SCHD, and VOO. I have a big chunk of it as well, but my consistent investment strategy right now is more focused on individual stocks. So maybe there will be a day in the future later on in the year where I get into the ETFs, but right now, I mean, for me, I'm just going to keep sticking the course from there. But again, it's all everyone's personal strategy. I'm just building my positions. I think that's going to be a good segue into our next question of, are we trying to create new positions? What are we doing during this year? We've both been very vocal here on this channel, very, very vocal about how we own a lot of positions. And if anything, we're going to try and clear out as many of the positions as we possibly can. Just so we don't have to monitor. It takes time to monitor your positions, each investment, each dividend growth. It takes time. And maybe you have too many, especially if you're investing in ETFs. So the question here, are we trying to create any new positions? For me, if I am going to create a new position, it's going to be very selective in how I go about doing this. I'm going to focus on a company like Microsoft, where we've talked about it. If I do invest, it's going to be one of the best ones. I'm not going to mess around with like speculative positions that I'm not comfortable with. It's going to be Microsoft, one of the larger banks, something I don't own already. But more importantly, I'm going to set a pretty high bar for dividend growth. I want it to be an aristocrat. I want it to be a king. If I'm going to bring a new position in here, I'm going to do my best to make sure it is the highest of quality. Otherwise, I'm just going to keep looking inward to build into a lot of the positions I've already built and keep growing them to avoid too many small positions.
I dig it, man. And, Microsoft, they'll be an aristocrat soon.
Yeah.
Obviously, like I was saying earlier, you do have a lot of positions you were bolstering in 2022. Texas Instruments, Qualcomm, Stanley Black & Decker. I mean, a lot of positions that you're really bolstering.
Yeah, and I think that's really what it is. In the past, what I've done with free trades made it a lot easier. It would have been I'd stop at Qualcomm at 10, pick around somewhere else. Now I want it to be 25, 30, 40 positions. Yeah, we'll eventually get to 100, but Stanley Black & Decker, just keep adding to it. Medtronic, my wife now owns 27 shares of Medtronic. I want to keep growing those companies so I can get some pretty nice sizable positions with these aristocrats and with these kings. So I think another piece of what we're learning here is in the long run, the aristocrats, it takes a year like last year to realize how important it is to invest in dividend quality in good times and then in bad times too, to see which companies continue to perform slow and steady. You may not get the highest of the high, but if you look at a lot of the aristocrats we own, they performed better than the market last year, and they still managed to grow their income while many companies outside of the sector were falling and even cut their dividend.
Yeah. And I mean, for me, new positions, like you were saying, and just to kind of define it here, eliminating positions that make sense. Warner Media Discovery, Allianz, there's a couple of the chemical companies still that have been shaken out through the Dow DuPont merger, deconversion, you name it. There's a few on my sheet, MDU Resources. I own Eaton, great companies, but very small positions. So it's like, do I want to have this $500, $700 position? I'm in the upper 60s in individual stocks in my taxable account. And, it's like, yeah, are there like 4 positions that have no dividend growth, maybe even no dividend yield? Can I get rid of those and move it right into a dividend growth stock?
Yeah, and that's the funny thing too. I'm very much with you on that. I think like in my wife's portfolio, and one of them, I have like 2 shares of TJ Maxx. Great. I wish I would have bought a lot more TJ Maxx when I did, but at the time we only bought 2 shares. Like, what is that position going to do for me in the long run? Why not just roll it into another position? But yeah, Warner Media, we have this $500 position from the spinoff. Like, what are we doing with that? What do we want to do? Halion, what do we do? I think, was it the IBM spinoff? Was it Kendrill? That company where we each have like 2 to 3 shares of it? Like, what do we want to do with these positions from there? And I know one position I'm looking to eliminate. I don't know why I have never done this. I think I missed my chance. It is Occidental Petroleum. Like, I know Buffett invested in it. The yield's what, like 0.7% right now. Even if Buffett triples the yield on that, that's still only 2.4%. From there, it's like, what do I want to do here with my Occidental Petroleum position? Like, do I use it for Microsoft, where in the short term I pick up more yield, but knowing that I'm probably going to lose some there? Or is there an aristocrat that's yielding more? Is there a different company that I want to lump it into where I can earn more and also get it into a company that doesn't have the checkered history that Occidental Petroleum has? Like, to me, that's my number one position. I just want to get rid of, because I have a ton of oil company outside of that. I also own Exxon, Chevron, Shell, BP, Total. I own a lot of oil here. So it's not as if I'm just cutting out my oil. Yeah, I mean, I'm basically drinking, I'm not drinking coffee every morning. I'm just drinking oil out of that coffee mug. So I think this is going to be a good cleanup year. If you want I think this will be a good cleanup year, slim down the portfolios and get it focused in the right type of positions.
So guys, in summary, we're trying to put cash, where it makes sense in cash still, treasuries, money market accounts, high yield savings like Ally and SoFi for emergency down payment, just to try to grab some risk free as high as you can. ETFs, I'm obviously re-bolstering my strategy with Vanguard ETFs. Bert's not yet. Creating new positions, it has to make sense. Again, links are in the description to our dividend stock portfolios. You'll see how many stock positions we have in our portfolios, and they have to make sense. We're both on the same page there. Bert doesn't want to hold small positions, and he also doesn't want to create any new positions with $200, $300. He'd rather make it a big position, moving a lot of other small positions into a big one possibly.
Yep. And so let us know too, if you enjoy this investing series. We want your feedback on this, and let us know what other topics you want to cover. We'll throw some tweets out and see like what you'd want us to roll into this too. Like, it's all discussion. We enjoy it. We're having fun. I just wish I would have had a beer tonight while I was recording this, but I didn't. And that's the next one. And stay tuned, because I think on Sunday we're gonna have another giveaway. We're gonna see if we can actually hit 400 likes this time in our next video. So make sure you stay tuned and you stay plugged in.
Hey guys, if you haven't already, like this video, definitely subscribe to the channel. We appreciate every single one of you guys. We're trying to get to that 20,000 milestone at the end of March, so we got a little bit of time, but the gap is closing. So let's get there. Let's fire up this dividend channel. Let's get to financial freedom. Bert, what else you got for us, brother?
If you're not with us, you're against us.
That was Bert the Hurt Hinley from the Dividend Diplomats. Over and out.